This is the Portfolio Coach Podcast, featuring Derek Davis, founder and CEO of Portfolio Coach. For more than 30 years, Derek and his wife Jennifer have been coaching their high net worth clients to financial prosperity.
Well, everybody, welcome back. It's good to be on another Monday call, thinking about what's happened in the markets and learning how Portfolio Coach is an asset in your decision making for your financial plan can really set you up for success. As always, Derek, we welcome you. It's always good to have your advice and input when we talk about these things.
Hey, great to be here, and excited to try to help people out. So the market's been very volatile, and so we've been in a lot of protection, and maybe for a little while we'll have to see what the quant says. So, but yeah, I'm excited to be here. Thanks.
We noticed, let's talk about that for just a second. We noticed last week we saw a little bit of optimism, right? There was a day or two where some good things happened. We saw a bump upward in the market, gave us a little bit of hope that our portfolios were going to come back. And already this morning, a lot of those gains are being shed by the market. A lot of people are selling off. What are you seeing? What are you thinking? What are you hearing out there? Should I be a buyer? Should I be a seller? Should I be in cash? What's generally speaking, what are you seeing out there and hearing in the market that's helping guide your decision making?
So just looking at this year alone, we've seen this is the sixth 5% correction with a 5% bounce. So we're seeing a lot of volatility. Naturally, it's dropped in a couple times more than 10% and seen a 5% bounce. So there's a lot of volatility in the market. Last year or last week, we saw what they referred to, or we think we saw what they referred to as a dead cat bounce. And basically the market's going down, but people wanted to close out or start the new quarter by buying in, believing there was going to be a summer bump. But earnings start this week, and earnings forecasts are pretty high. And I think that they're going to come in a little lower. And basically the market is just a multiple of earnings. So if the S&P 500 is earning $200 and we have a 16 times multiple, then 3,200 should be the price of the S&P 500. And currently it's up at about 3,800. So we've got a little bit of pain to go, I'm afraid.
Well, it depends, right? That pain depends on whether you're utilizing the tools of Portfolio Coach, which is actively traded and right now heavy in cash, very protected on the downside, or whether you're out there chasing the market and picking stocks based on this Reddit post or that tweet or whatever else. I mean,
very true.
So and I think people are wise to keep an eye open and to look for opportunities. But it's interesting, if the philosophy of active portfolio management without good tools and without a good algo to help guide that decision making, last week you might have jumped into some stuff that you're already losing on, and making a decision now to even further the downside is a temptation generally.
No, in human nature is that way. Certainly you could buy now and you'd be buying low. We just believe that you could be buying lower in the future, and we'll wait for the quant to tell us when that momentum's bottomed. Non-cyclicals, things that people have to buy are holding up pretty well, but things that people, concert tickets or things people choose to do are really struggling right now. So the basic stuff is doing pretty well, but the optional stuff isn't doing well, I guess.
So as we talk about that, one of the sectors that's been performing like gangbusters lately has been the automotive market. And I have some friends in the automotive industry, and they still think there's some legs in that industry for another 60 days or so. What are you seeing? Because we talk about concert tickets, we talk about some of those luxury things, it's discretionary dollars go towards entertainment, et cetera. We're in the dog days of summer now. We're a few weeks away from some school districts going back to school in the country. How do you see the impact of automotive, the used car market shrinking, slowing down, or maybe even having a screeching halt? What do you see happening in certain sectors related to those behaviors in the market?
Yeah, we started seeing a sell-off on the momentum of the stocks. The stock market is forward-looking. Anywhere from, well, on an average, I'll say from 6 months. And so we started seeing a sell-off in the stocks of the automotive, 6 months ago, three months ago, 6 months ago, depending on if you're dealing with the dealerships or the manufacturers. And now you're seeing the interest rates go up. I don't see a whole lot of people running out to buy a car and paying 8 or 9% interest when they could have bought one 6 months ago, and they know they could have bought one 6 months ago, at 4%, at half as much, or at 4% interest. So, I hope your friends are right if they're in the industry, and I hope they do well for the next 60 days. But we're going to be on the sideline on those stocks until the downward momentum stopped, and we just didn't want to participate in those corrections of those stocks. You look at a Carvana, and it's just it shot up, and we've almost completely come back to where it started. Just the car market just isn't as strong as it used to be. So,
which is, that's another indication. Carvana as a business is actually a really strong business. It's a really innovative idea. It's really revolutionizing the way that the car buying experience goes for a lot of people. So it's not a bad business, but that irrational, scream to the top, and then the resulting correction on that is impacting people. That leads us into something I want to have you talk to us a little bit about. Talk to me about sectors. In Portfolio Coach, you have the opportunity to analyze your portfolio or to manage your portfolio, and you can break those choices down by sectors, industries, and fundamentals. And we've talked a lot about fundamentals and what role they play in decision making, and how those fundamentals have created the foundation of success for people who utilize Portfolio Coach to manage their portfolios. Let's talk about sectors today. Coach us up a little bit on how utilizing the sector's functionality in Portfolio Coach gives us an edge when it comes to making decisions for our teams and our players in our portfolios.
Yeah, so we have 5 sector portfolios, as we have 5 industries and 5 fundamentals. But the 5 sector portfolios are going to be your consumer non-cyclicals. Those are going to be things like gasoline, heating oil, food, clothing, things that you need. Then you have the consumer cyclicals. Those are going to be things like the concert tickets, maybe travel, vacation, things you don't need, but you want. And then we have basic materials. That's going to be more so like the non-cyclicals. That's going to be more of the things that you need. Technology, definitely something that does well when people have extra money, because they can go out and buy that new cell phone, or there's so much technology out there right now that if you have extra money, you typically go out and buy it. And then lastly, we have finance, and finance is going to be more of the neutral, and the banks and such like that. So if you feel like the economy is going to struggle, you may want to go into basic materials or non-cyclicals. And if you feel like the economy is roaring, technology and consumer cyclicals is always a great place to go. If you're really not sure, finance is usually a good place to go, especially with interest rates going up. If the banks are still paying you 1%, but they can lend out at 8%, their top line is going to be much better, which is going to help their bottom line, which is then going to have a multiple, and so their stock price is going to go up. So those are the 5 sectors that we do, and it's a nice balance of conservative and aggressive, with moderate kind of being in there with finance. Right now, I'm kind of looking at the chart. Consumer cyclicals and technology have 100% cash and 80% cash. Whereas the non-cyclicals and basic materials are down at 50% cash and 20% cash. So obviously we hold more of those stocks in the non-cyclicals because they haven't been hit as hard during these corrections as much as technology, and that's why we have just so much cash on the aggressive side right now.
So if I'm applying what you're saying and what you're talking to me about sectors right now, and I'm thinking, all right, I've got some cash on hand. I've been managing my teams according to the weekly signals that come in, and I've been following suit. If I'm looking for wins, I'm probably not going to find those right now in finance and banking because interest rates are rising. It's more expensive for banks to acquire cash, and the rates for consumers are getting high enough now that consumers are sitting on the sidelines and saying, maybe I'm going to wait. Maybe the Fed will be able to curb inflation, and maybe rates will come back down again, whether that's for buying a home, buying a car, financing a vacation. So I'm on the sidelines there. If I'm being smart, according to the way that the portfolio coach is trying to teach me, I should wait on those things. Another one that I should wait on is technology, because the technology sector requires cash. It requires disposable income. It requires excess cash over monthly maintenance and responsibility. But a place that I might want to look is I definitely want to stay in a strong cash position because of what happens in those two sectors when it comes to my technology or my financial markets. Which of those sectors, if you had an inkling, and I'm not asking you to rub the crystal ball here and tell us the future, but of the sectors that you are really watching the algorithm to tell us to come back into sooner, which of those are you leaning toward? What are you seeing in that sector data?
We have a saying here: you always want to skate where the puck's going, not where it is. And that's basically, where do we want to be in the future? Consumer cyclicals with 100% cash right now might not be a bad place to be. It's lost 11% this year, but the market's lost 20. And then you're going to start getting signals on those stocks that have bottomed, and it's going to start buying back in. And so that could be a good place to go if you're younger, I would say. If you're older and more conservative, perhaps I might stick to the basic materials and the non-cyclicals. They haven't lost nearly as much this year. They've lost less, but they're still going to be upside. So those portfolios will become fully invested first, most likely. Whereas the consumer cyclicals and the technology and finance will take a little bit longer to buy in, just because those stocks have fallen so much. But we still think there's more pain ahead. So unfortunately, for the broader,
well, unfortunately, Oh, sorry. Go ahead.
No. I just, it's Portfolio Coach is great. It does a really nice job of protecting to the downside, but it's not a hedge fund. And so if the whole market's going down and we own one stock, chances are that one stock's going to go down. Yes, that's only 10% of your portfolio, but on a day like today where the market's down 2% and you're 10% invested, you're still probably going to be down, 20 basis points or 1/5 of 1%, but you're still going to be down. We haven't figured out how to make money when the market's going down. So that's tough to do.
Well, you and most other investors, right? I mean, and I think that that's a critical point. Again, I don't know that we can reiterate that enough about why Portfolio Coach is a wise investment to be your guide and helping you personally manage your portfolio, because everybody gets hurt on a down market, and the people who end up really succeeding in a down market are people that go to cash at the right time and have liquidity and don't compound bad decisions with bad decisions.
Correct.
They don't hold on to a sinking ship, even if it's a great stock. Even if I believe that Tesla is an absolutely amazing stock that I should hold forever, the active trading allows me to come out of it, go to cash, let it drop, let the market do what it does to it, and then get a signal on a Saturday and take a look on a Sunday, place my orders and get back into Tesla when the algorithm says, hey, things are moving in the direction of being back into this. So utilize your liquidity to take advantage of the upside and take less of the downside. I think that's probably one of the most important principles that people can learn about Portfolio Coach, or even understand that that's one of the primary benefits is Portfolio Coach, as you've said a number of times. It's not a silver bullet. It's not gonna change the market. What it's going to do is it's going to be your guide and helping you manage a portfolio of investment teams by knowing which players to move in and out at a specific time so that your downside is mitigated. And sometimes maybe your upside won't run like other people's will, but those people are going to participate in more downside because of the algorithm and its track record of success.
Yeah, no, that's exactly what we're trying to do. So we're making more by losing less. We earlier today we were talking about Carvana, and so I clicked over to see where the screen was. In January of this year, it was at $225, and today it's down another 11%, so it's at $22. So basically, it's lost 90% of its value. We're on the cash. We'll buy back into it at some point. It just, yesterday obviously wasn't the time. You would have lost another 11%. So we just have to be patient, and cash isn't a bad thing. Not losing is a good thing when the market's going down, and that's what we've been able to do at Portfolio Coach, and we'll keep trying to do for you. So,
now, some people would argue with you on that being in cash right now with inflation rising so much and being in some low yield money market or savings account, even for someone who's not a big investor, they would argue that because you're not in somewhere and because inflation is rising so rapidly, that cash is bad because you're losing against inflation. What do you say to that?
You're certainly losing to inflation. Right now, I'll say inflation's at 6%. So if you're 100% in cash and you're making 1%, you're losing 5% a year. Losing 5% is a lot better than losing 90%, as Carvana, has proven. So, and then we'll take advantage of buying it back lower, and then when it bounces, we'll participate on the upside. So you are going to be losing to inflation, I guess, but you're going to sleep a lot better at night knowing that at least you have the same money that you started with, just not as much buying power.
So to bring it back and to wrap up our conversation today, specifically regarding sectors, I know we've traveled a little bit in our conversation today, but to bring it back to sectors, if I'm utilizing Portfolio Coach to its optimal benefit for me right now, and I'm a sectors oriented person, which I actually tend to be. I like to watch sectors. I like to see what's happening. I love the Dow. I love to watch the Dow as a hobby, I guess, if nothing else, and see what those blue chips are doing. And that's very sector driven for me, the analysis is, and that's how I was trained when I was in school and getting a finance degree. Was we really focused on sectors, and so obviously I'm inclined there. Final thoughts for us in terms of not utilizing necessarily, but optimizing the value of that particular an analytics tool for making decisions about where to place money in teams.
If it was me, and I'm older, I would probably be in basic materials or consumer non-cyclicals. Those aren't going to drop as much. It's going to be your, your soap, your gas, your clothes, your food. If I'm younger, I probably go into consumer cyclicals. I know that doesn't make a lot of sense, because right now, if you went into it, it's 100% into cash. So you really wouldn't be going into it. But over the next, 6 months, during this bottoming process, we'll get some buy signals, and you'll be buying in, hopefully a lot lower, and participating in that upside. So I might go into consumer cyclicals if you're on the younger side. So
Awesome. Well, Derek, again, learned a lot.
Had always have fun. It's great. We've been doing this a long time, hence the gray hair. But hopefully we can give back and help people. So it's always great talking to you.
Awesome. Great. Well, we'll talk to you next week.
Have a great day. Take care. Bye-bye.
Okay. Bye.
Visit get.portfoliocoach.com to get 90 days of gold subscription for free.